A little over a week ago, the county executive proposed the FY27 budget. So everyone's wondering how the county executive was able to close a $170 million budget shortfall without increasing taxes and without making major cuts. I did some digging for all of us to try to figure out where that $170 million was covered. And what I was able to find is that even though property tax rates are not going to increase, if you're a homeowner and you have a mortgage, you will see an increase, at least a third of us, to our property tax assessments. So that brings in an additional $92 million in revenue. And that process is a state process. The state determines our assessments. They do this every 3 years for a third of the state. And so a third of us could potentially see increases, but this budget relies on those increases to the tune of an additional $92 million in order to help close that deficit. There are many of us who, of course, because we're seeing increases in costs across the board, we likely can't afford to continue to pay property taxes at the rate that we're paying them, let alone an increase. And so I don't think that, again, that we should be so heavily relying on residential property taxes to fund our county government and our county expenses. Right now, we are seeing increases in gas prices, in grocery prices, astronomical increases in utilities. Everything is inflated right now. At the same time, within a year, our unemployment rate has gone from about 3.2% to 5.4%. So right now, we know that people are feeling the squeeze from reduced income or no income and trying to grapple with all of these rising costs while they have less income to pay those costs. And so right now we don't need a higher cost for taxpayers in order to close that deficit.